Welcome to the big idea of 2025. What we try to do in this set of conversations is speak to experts about what they believe would they believe 2025 would look like, and what is the big idea according to them for the year. On the corporate side, on the market side, on the economy side, our guest today is Sanjay Mookim of JP Morgan. Sanjay, good having you. Thanks for taking the time out.
Pleasure to be here.
Yeah, so well, what's the sense? 2024 was as volatile a year as it can be on all counts, right? Geopolitics, markets, economy, earnings, what have you. More of the same in 2025, or will it look materially different than 2024?
Well, Niraj, I think the first half or the first couple of quarters really will contain more volatility, right? And this stems from the change in administration in the US. The new administration is talking about a whole lot of policy that they want to do either on day one or in the first 100 days of administration, etc. And many of them will have significant implications for the rest of the world, whether it is on tariff policy, whether it is immigration policy, or just deficit reduction in the US as well. If many of these things happen, they will drive consequences and policy decisions for other large countries. So I think the markets, policymakers everywhere around the world are in this wait and watch mode to see what happens, how much of these promises are executed, and what the consequences for an emerging economy, let's say like India, are. And therefore, my sense is that you will see a continuation of this volatility, perhaps even an increase in volatility, at least into the initial few days of the new administration.
Okay. Just a bit of the global piece before we also turn local, or we'll kind of be fluid between the two. But I was reading a statistic about how the US markets have done or outperformed world markets in 14 out of the last 15 years, right? And 2 years on a trot now have been superb returns. What's the JP Morgan view about, let's say, US markets in 2025? And could what the mother market do, will that have a large implication on what emerging markets like India do? Or will we have a different course, never mind what the US markets does?
The longer term correlation of relative performance of, let's say, equities or currencies is driven by relative growth outlooks, right? In the short term, you talk about interest differentials and inflation differentials and all that, but the medium term correlation is very simple: asset prices driven by relative growth. And if you look at, let's say, the US economy, and this is now popular in the press, many people are talking about how the EU was as big as the US in 2010, 2012 or something around that, and now the US is 50%, 60% bigger than the EU. The relative growth dynamic has been favorable to the US for a very long period of time. Yes, EM has had better growth, but EM has had currency issues as well, right? So there has been particular volatility in other risk-adjusted parameters for EM. But if you take global GDP, the US has actually done much better in growth than many other parts of the world. And this has driven the outperformance of its market. You can bottom up also point out to many technological changes that have happened, the whole boom in the, let's say, the internet companies to begin with, now AI driving tech stocks in the US. But ultimately, it's a relative growth argument. And if you use that framework, Niraj, then for next year, are we arguing that either Asian growth or European growth is going to accelerate more than the US? The answer is probably no, right? For EM, China still dominates in terms of the GDP contribution, etc. And there is potential for China to do well if the stimulus comes through, but there's a lot of ifs and buts around that. So let's assume that the Chinese government did decide to stimulate in size sometime next year, post CNY, let's say. Then we can review our opinion of EM growth. But absent any of that, it still looks like the US will grow faster, risk adjusted for than most other economies.
So I'm glad I don't have your job, because I'm about to make your role a bit difficult. But here's my question to you. Let's assume, hypothesis, China does stimulate. The recent noises do seem that they want to, right? Let's assume they do stimulate. Let's assume the US tariffs are not anti-growth and are not very inflationary as well, right? So therefore, you have a US market which is doing well, or the US economy and markets doing well. China stimulating, maybe China also doing well. India coming out of a growth patch and unpredictable growth, or growth lull patch, and therefore unpredictable, but maybe better than what's happened in the last three. Where does money find its way?
Okay. Assume that's China stimulus. Now, there can be stimuluses of various forms and colors,
The
right?
best case scenario.
Let's say they do a broad-based consumer stimulus and they hand out money, which is not anybody's base case. Its idea is more of an infrastructure, real estate stimulus. In any case, people will start off with the assumption that the impact of the stimulus is likely to be temporary because of the underlying demographic headwinds that the Chinese economy faces. So you may get a spurt of interest in China or in EM assets because the flow through of Chinese growth into EM can be reasonable. You may get that period where you get interest in China, but everybody is very likely to approach it more as a temporary phenomena rather than a permanent change in the direction of growth, really. In this, India has stood out historically. So if you look at the performance of, let's say, MSCI India to EM, India's behaved like the S&P 500 up until the elections in the US were conducted, right? Because Indian growth was different from EM growth for a very long period of time. Okay, but as the administration changed and we got the results, let's say, of the US elections, India is now bucketed in with EM again, and India's performance is now tracking EM assets more than the S&P because of the shift in perception, Niraj, that the policies of the new administration is US first.
Right.
And everybody else, doesn't matter, friend, foe, whatever, US first, US exceptionalism, my growth comes at your cost, right? So India is now being lumped back with EM in investors' minds for now, right? But can India outgrow EM? Well, that's our hope and base case, to be honest, and it should be outgrowing the rest of the EM next year as well.
Okay, and one small macro before I get to the minutiae, if you will, but from a slightly 50,000 feet view, is this: if the US were to slap tariffs, left, right, center, let's say Donald Trump does that, and if that is inflationary, let's say, and therefore this belief that US might also continue on a rate cut trajectory doesn't quite turn out to be true, and the US were to hike rates as opposed to cut rates, what happens to policies back home, for example? Because a lot of people argue that we need the rates to come down in order to stimulate capex growth, so on and so forth. Will the RBI still be able to do that, or could there be a spanner in the wheel?
This will cause trouble. Now, there are multiple variables through which that tariff will impact policy making, right? First, how do you counteract tariffs? Suppose they impose tariffs on China or Mexico or any of the countries that he's talking about. One way that economy can react to tariffs is by allowing the currency to depreciate, right? And that's what happened the last time around as well. So let's assume in response to tariffs, the RMB were to weaken. Indian policymakers cannot allow the rupee to strengthen relative to the Chinese currency, because that will then force more Chinese imports into India. So you may not have any tariffs imposed on you, but you will also have this incentive to have your currency depreciate in line with every other major economy. You don't want to lose your export competitiveness, right? So there is a currency risk even if there are no tariffs imposed on us directly, okay? The inflation will be ring-fenced in the US, right? If you put tariffs on the rest of the world faces deflation. Right? Because my growth slows down, my ability to export to you reduces, and therefore I have more surplus production, which I have to sell to fewer amount of people. So I actually face deflation, and the US economy probably faces inflation. So slower growth for everybody else, inflation in the US growth, we will think about how that plays out. But for policymakers in EM, you are faced with the prospects of potential currency depreciation and slower growth and deflation. So ideally, you want to cut rates in India as elsewhere. This will depend on how bad the currency depreciation is. Because if currency depreciation is very harsh and you see dollar outflows of any economy, not just India, let's say, you then don't want to cut rates. So, put this in a nutshell, right? The policy choice that faces many central bankers over the course of 12, 18 months, do you cut rates to drive growth? Do you keep rates high to save the currency? My sense, most will choose to cut rates to drive growth, because saving the currency is probably going to be futile.
It may remain a very bottom-up idea with stocks which are favored by domestic investors who can maybe just allocate down the curve on the market cap. that might be more active as opposed to the headline Nifty 50 or the top 100?
Well, if you look at MSCI EM, the largest off benchmark allocations, so do you own stocks which are not in the benchmark? It's the highest in India, even by foreigners, right? Because it's no longer true that only the domestics look at mid or small caps. Because the markets become big enough, liquidity has grown, and growth in some of the smaller names has been reasonably strong. We have genuine interest in small and mid caps, even from a broader foreign institutional set. Yes, it's true that the foreigners predominantly own the larger cap companies and the mid caps are predominantly owned by domestics, but it's no longer as ring-fenced as it used to be. There is enough interest for meeting smaller mid cap companies by my foreign clients as well. Okay. And of course, India being a high growth economy, you can always find enough structural stories where the business looks great, the valuations are right, etc. But you have to exert your effort. What happens in markets which are slow, the set of high growth or companies where you have confidence reduces. When growth is strong, that set of companies that you like can expand. But in any market, it's always possible if you put feet on street, go meet 15 people, companies, you'll find one where you have confidence on growth and valuations.
So tell us, Sanjay, I mean, where is it that, I mean, in case there is a thematic note that you're writing or have written or what have you about 2025 and pockets that you might want to advocate based on the GARP principles that you might have, or where you believe that you genuinely have seen invested interest? Because I was present at your conference, right? It was so well attended.
Yeah.
And even the companies, they were really large companies, obviously, but there were also these non-Nifty 50 companies, large enough, but not like mega caps from Indian parlance, right? So where is it that you believe there is heightened interest in this bucket that you spoke about? Not Nifty, not necessarily Nifty 100, but there is enough interest.
So if you look at themes, it can't be a 2025 thing, Niraj, right? You'll have to take a 3, 5,
okay.
6. So if you talk
But you start in 2025.
2025, we can talk of cyclical stories. So we'll think, of course, you'll get a power up cycle, seasonal demand in April, May, June, and you'll have power prices going up, power shortages will go. It's predictable. It happens every summer. It'll probably happen this summer as well.
Okay.
We expect real estate demand to recover, for example.
Why so?
Pre-launches have been weak because a variety of reasons, right? Elections in Mumbai, etc., have kept launch momentum weak. We expect the launch momentum to start to go up again, and that should drive a renewed interest in real estate stock also. I can talk about, let's say, at some point later in 2025, a peaking of credit costs, but that is a iffy thing at the moment, right? You can't really get very confident about it at the moment. We'll see how this plays out, right? Because expectations for banks are not very high at the moment. But if you take a medium-term view, there are many places where things are changing. Let's say the energy space itself, renewable energy, and the kind of investments and momentum we are seeing in some of the renewable spaces in India is very strong. Especially if some of the storage solutions starts to work, then the whole game changes really in terms of energy generation and renewables in India. Manufacturing is working, but it's more to be approached bottom up. Which company is actually executing? There are companies which are successfully exporting. Again, there's no undiscovered stock now. Everything is fully valued and discovered, but you can still find those growth avenues in the country, right? So again, I would say that, look, a thematic approach has to take a slightly more long-term view. We have cycles that are visible in 2025, which should start to go up.
Okay. So let me just quickly get this out of the way, and then we try and talk about what is it that you watch out for the most. I mean, one is obviously the Trump 2.0 era and what happens there, but beyond that, there will be other things. But just to wrap up this point or circle the square, just say, or square the circle, if you will. So 2025, maybe look at power, because there is some demand that will come up, and real estate demand revival, if you will. So play the real estate demand revival as well as power via mainstream companies, which is power generation and real estate, or play it via ancillaries?
Well, the direct companies are always the most leveraged to any theme, right? But if you can find something cheaper in an associated business, right? In building material, I don't think there is any cheap building material stock, for example, right? But if you can find, please do look at them. But the core theme is that real estate construction, real estate pre-launches should start to improve here on.
Okay, just one last question for 2025 on that. And there is a lot of talk of Capex revival, right? So you don't want to play the Capex revival theme at all, because it's kind of the last 3 to 4 odd months, it's been neglected a bit.
So there's three answers to that question. Okay. First, in the very short few months, there should be a significant acceleration of government spending.
Right.
If you look at the budget, 11.1 trillion rupees of budgeted capex, the implied capex for November to March should be up 61% YOY, because the first 7 months the government has really struggled to get the money out of the door. It looks like maybe they will miss the 11.1 trillion target, but irrespective, there has to be significant acceleration. So you can see that coming. Everybody knows the math in the investing community. Everybody is thinking of what to buy. Why is it not happened already? It's the middle of December. When is Capex going to start, etc. So that's the short-term view. The slightly medium-term view on government Capex, Niraj, is that the historical performance of 30% odd growth YOY in government spending cannot be repeated.
Agreed.
Right? Because there is no fiscal room. Your revenues will grow in line with nominal GDP, and you can probably grow Capex in line with nominal GDP or maybe lower, because there is the objective of bringing the fiscal deficit down.
Yeah.
Right? So the overall momentum in government Capex should normalize at a steady state here on. The third part is this entire anticipation that private sector Capex is going to recover dramatically, right? That once the government slows down, companies will step up. And the reason for this is that balance sheets are very healthy.
Yeah.
Most companies are sitting on no debt, right? And 3 or 4 companies I spoke this week have promised not to have any debt in the future, right? Zero. Why? Right? And that's because of a risk aversion. You remember the IBC and the bankruptcy issues, etc. So you say, okay, look, I don't want any risk on my balance sheet. So that risk aversion is not changing overnight, one. However, if you look at total Capex investment to GDP, that is not a bad number, right? It was higher only in the post-GFC 11-12 period when we were building all those power plants, etc. So to argue that it will naturally go up because it is somehow low is not correct, because the investment to GDP number is not low at the moment. So it will not just naturally go up in sort of an automatic fashion, to put it that way.
Okay. So you're not based on all of these factors plus the fact that the valuations, even though the stocks have been neglected, haven't quite corrected. You're not very hot on this. Let's let the proof come out, then maybe think of it if the valuations are appetizing. Otherwise,
on the Capex front,
yeah,
a very
Capex
tactical view for the next, let's say, 5 months as the government catches up on its budget program.
Yeah.
That is a very obvious sort of.
But how do you play that? Do you play road infrastructure? Do you play the machinery companies? Do you play? How do you do that?
You buy a basket of everything that benefits, right? Even some cement companies, for example, or ENC companies, or the large cap ENC company.
Got it.
Everything should benefit, I would argue.
Okay. The slightly medium-term theme, which let's say starts. So we're talking about 2025 and what happened, but energy transition you spoke about, well discovered, well spoken about. As you said, no undiscovered name, right? Companies are talking about 50% growth till 2030. I was talking to one company today, KPI Energy, which said that 50% growth till 2030. My question is, how do you? Do you buy some of these names which are showing high promise of growth, but the valuations are high? Or would you wait for a corrective phase to come in and then maybe go there?
Let me start with a more macro reply to this, Niraj. We've done quantitative work. Again, it's very fashionable, so we've done it ourselves using AI, ML, etc.
Okay.
To track the reliability of management commentary. Not any sector, but we've taken the history of management, transcripts from conference calls. We scored it, made lines of it. The predictive power of management commentary across every sector and every metric is 0.
Wow.
So management commentary tracks what is happening the current quarter. It has 0 predictive power for most sectors in India. So if management is talking about X growth happening in 25 or 26, they have an opinion. As an investor, I can have a different opinion, and that is what gives me an opportunity to either decide to invest or not. So to your question, if something looks like high growth, I should assess it myself, right? Not just relying on whatever man. But if it does appear like high growth, I would, and you have confidence in your analysis to say, look, XYZ sector will deliver so much growth till 2030, then the valuation criteria becomes a little bit secondary in the current market setup, right? Because growth is accorded a premium. In fact, I was reading some research which says that because of the increase in bond yields in the US, the implied equity risk premium in the US has gone to 0. Right? And that's because people are paying for growth. So in the current framework of the market, the growth characteristic will outweigh the valuation filter.
Got it. But I'm surprised. I mean, well, sure, IT companies may have faltered a little bit here and there, but by and large, if they're making those predictions of annual growth of 9, 10, 11%, they've lived up. So in some sense, some companies have reasonably strong predictive
No,
powers.
even
No.
for those sectors, we've tried it quantitatively.
And not working.
The correlation doesn't hold.
Fair call. I won't challenge that. I'm sure you've done your work. So, okay. But point well noted. Okay. Yeah. So, of course, do hard work and may build your hypothesis, but understandably so. So, okay, we've spoken about, now coming back, we have about 4 minutes left on the show, coming back to the key question, since we are talking about 2025 and the big idea, what's that big idea? I mean, is the big idea to track what the US does and follow everything from there? Or are there things that could also be independent of what the US does and still very important?
Well, the first part will be what the US does, right? So let's say if the geopolitical uncertainties end and the wars find some ceasefire, that will have an implication on commodity prices, on supply chains, etc. So that is an event that cannot be ignored, right? And like say the first part of the year will largely be driven by outcomes of those decisions. The second half will then play out in response to what has happened, right? So let's say if the wars have ended and the supply chain issues are solved and oil prices start to go down, that's great for the Indian economy in a way. But can I take a confident view that this will happen? Not yet.
Got it. Okay. Okay. The other thing is all the breakthroughs that are happening on the global technology front, right? I mean, do you guys find opportunities India on that at all, or is it largely absent and it's more maybe the new age tech companies notwithstanding, largely old economy sectors and energy transition that kind of rules the roost?
So again,
as a big thing.
These are popular topic on social media as well. And one of the refrains is that, look, India has a lot of these companies just not listed.
Yeah.
Right? These are a lot of American companies that operate in India, bringing all that new age technology to India, but they're not listed. Do we have large product companies that we don't?
We don't.
Yeah.
Okay. Do you guys like the limited product companies that we do have? I mean, everybody's talking about how they are hitting consumption in a big way, or the consumption companies in a big way. That consumption is happening. It's just a different set of players who are now coming up. Maybe they are unlisted. Maybe the Zomatos, Swiggies, and the others are facilitating those growth numbers, etc., and stuff like that. And therefore, they are hitting the pure play FMCG and other consumption companies. Do you like the tech-enabled plays, whether on the consumption side or the fintech side?
See, one thing, India is a highly competitive market.
Agreed.
Right? There's tons and tons of consumer companies across the country. So if X opportunity opens up because some incumbent is operating at very high margins, and that leaves the door open for some mid-cap or a creative tech solution to kind of squeeze into that margin, then that will happen.
Right.
And I think some of that is happening at the moment because Indian consumer companies do operate at a very high margin environment. Do I have real-time data to show you a chart that this is happening? Not really. Anecdotally, we believe this is exactly what's probably going on in the consumer space in India. So this tone from the listed companies, oh, consumers weak, etc., maybe need to re-examine in the context of what's going on. On the consumer tech side, there is definitely a space for convenience retail. How big that space is the debate. Right? How many people will pay for the convenience that these tech solutions provide is an open question. Currently, it's growing very rapidly because there is cash burn. Okay, but once you stop burning cash, what is the realistic TAM of consumers who will pay a premium on a grocery basket for the convenience that these companies offer? Nobody knows that answer right now.
A lot of question marks around the actual numbers of the total addressable market for a bunch of companies.
That's right.
Starting to come up, Sanjay.
Yes, because if you're losing money, your time looks big. When you stop losing money, your time may actually be different.
And that's across industries.
Most technology-driven stuff.
Most technology-driven
yes,
stuff.
That's right.
Yeah. Okay. Fair call. Last question. Where are you very negative, or if not negative, if that's too strong a term, where is it that you're skeptical about growth coming back? Maybe the street believes that there will be growth, but you yourself don't think so. For 2025, the next 12 months.
I think our EM economist put out a very interesting thought piece on this. And the argument was that in the last 3 or 4 years, especially the post-COVID period, you've seen the Indian economy driven by services exports and government expenditure. Right? These have been the two key drivers of India's economic activity. both of them are likely to normalize. I mean, we're not saying that they will slow or decelerate or any of that sort, but they'll go to more normal run rates. The Indian economy needs replacement growth drivers, and that could either be a consumption driver or an investment driver. As of now, we don't see either of them improving. Right? So there is this scenario, which was a thought experiment, that in the absence of a recovery of consumption or investment, the growth rates of the Indian economy might actually settle at a lower average number.
Wow. And that might have, of course,
knock-on
effect on a number of things. Okay, so prepare, brace for low growth, possible low growth for a better part of 2025.
Hopefully not. It's just a scenario, Niraj, that put out.
But high probability, Sanjay, to your mind?
Something needs to change. We need to start to see some acceleration either in the consumer numbers or the consumption numbers or in investment somewhere.
Okay.
You can't get both.
You can't get both. Okay. Well, maybe in the first half of 2025, if things revive, we'll have a chat then too. But this is lovely, Sanjay, to just kind of probe your mind to try and think what are the high decibel things that are propping up. So thank you so much for that. And thanks for joining on the show today.
A pleasure being here. Thank you for having me, Niraj.
The pleasure was entirely yours, I can assure you. And viewers, thanks for tuning in to The Big Idea for 2025.